Hello and welcome to this very special show on the markets, which is called the Big Sell-Off. And we're calling it big, not necessarily because of the fact that the Sensex lost 500 points, but because of the fact that the start of the new trading year hasn't been particularly impressive.
Well, yeah, inauspicious if you'd like to call it that. So over the next 30 minutes, we're going to try and talk to you about the Shanghai scares that seems to have gripped global markets. Remember, it was the first trading day of the new year for global markets, and without a doubt, it has started on a down note. You had a sell-off in China that's rippled through global markets, and such was the damage that China actually had to halt stock trading after a 7% rout that even triggered circuit breakers. So what's the reason behind it? Well, analysts believe that it's manufacturing, for one, in China that continues to contract for a fifth straight month, which somewhere seems to be now casting doubts on the kind of recovery that you're going to see there. There's also worries that soon you're going to see an end of that ban on share sales by major stakeholders.
And that may only increase the volatility, but remember, it is across the board. The European equities too have crumbled. Dow futures aren't being spared either. And in this carnage, amidst all of this carnage, the Sensex plunged over 500 points, closing below the 26,000 mark. The Nifty too gave up the 7,800 level, a key level, as investors resorted to across-the-board selling. Banks, metals and auto stocks were at the receiving end as the market suffered its worst fall in nearly 4 months.
Well, that's right. And to really talk to us about this Shanghai scare and more importantly, the implications that it will have for global markets and India as well, we've got a stellar lineup for you. Paul Schulte, CEO and Chairman of Schulte Research, joins in. So does CMC Markets Jasper Lawler. We've got Arnab Das, Head of EM Macro Research at Invesco, and Market Analyst Ajay Bagga, all joining you in just a bit.
But before we go to our guests, let's set the stage for the discussion. And for that, we have Pamela Ambler as well as Manisha Gupta joining in. Pamela, first to you. There is a lot of volatility in the market. Most people know this sell-off, but to your mind, what was the key reason?
Yes, volatility is back and back with a vengeance. Look, investors have grown complacent. They thought they saw the worst in the third quarter of 2015, but this sell-off tells me there's significant margin debt and leverage. The volatility came from the weakness in both official and the private forecast of factory activity for the month of December. Manufacturing is under pressure, confirming the trend of slower growth. Services, that was better, but not enough to balance things out. There was not enough strength there, which confirms the trend of slower growth. And then we come to the circuit breaker. That was implemented today. I don't think markets expected that, and we saw heavy selling on the afternoon when it hit the first threshold. A 15-minute halt first, and 15 minutes later, markets resumed trade. The selling then continued, which triggered the second circuit breaker. That was the Rubicon that crossed and froze trade for the rest of the day. The index ended 7% lower for the Shanghai Composite. The panicked response to the circuit breaker really had a snowball effect where investors rush for the exit. The big question is, are we going to see buyers coming in on their lower levels in the next few days, or are we going to continue to see a meltdown? And don't forget, there's still lots of China data to come through. We have trade balance, import figures. Those will help paint a better picture of the external picture. And we've yet to see whole internal demand indicators as well.
Right, Pamela, tons of questions, and we'll put all of them to our experts. But Manisha, you do come in and talk to us about, the other big factor that seems to be triggering risk aversion globally, and that's the rising tension in the Middle East.
Well, absolutely. The first trading day of 2016, and you have seen a run-up coming in for the crude oil prices, and this is after 30 to 35% of a decline in 2015. Well, you have seen growing tensions between the Middle East. Saudi Arabia has cut diplomatic ties with Iran, and both of these countries are major producers of crude oil in Middle East, and that really seems to be supporting the prices. You have seen the geopolitical and risk premium coming its way into the prices. But then, having said that, there is so much else happening in the world. You did see the China manufacturing PMI data see contraction for a 10th straight month, and that did lead to some profit taking coming in for the crude oil prices as well. Apart from that, the crude oversupply in the markets is very much on the higher side. You have seen slowdown continue in China and much of other consumer countries as well. It's record high production that you saw from Russia in 2015, and the OPEC output continues to be on the higher side as well. And then, of course, the markets are waiting for the Iran output to increase as we head into 2016 in the the second quarter. So all of those factors would really continue to weigh onto the markets. Having said that, the experts believe that the first quarter and the first half of 2016 is expected to be very volatile and vulnerable as well. It's only the second half of 2016 that you will see consolidation and even some increase coming in for prices.
Thanks a lot for that, Manisha, as well. And this is the big thing when it comes to crude. I just wonder at times, how do people predict $20 per barrel so easily with all the tensions that are simmering in that region? It's just so volatile that any small spark could actually lead Brent and crude to just move up quite substantially. Anyway, choice. Right now, we're talking about the equity markets and the sell-off there. Special guest joining in as well. Ajay Bagga is with us too. Ajay, good evening. Thanks so much for taking the time out. I remember our conversation during the day today, Ajay. It didn't look so bad then, and you were anticipating maybe some stimulus measures coming in during the course of the week as well. Until then happens, if that doesn't happen, then it's a separate thing altogether. But until that happens, do you believe that markets at large would continue to remain nervous?
Yeah, markets will remain nervous, and Neeraj, you pointed out a good thing in the morning, which was that the larger shareholders would be finishing 6 months of the blackout period of not being allowed to sell on January the 8th. And I figured out a report also is out from Goldman, which is putting out this figure at about $185 billion, Neeraj, of potential stocks that could now be free to be sold. Of course, it doesn't mean that all would get sold on January 8th. So probably that was also a factor spooking the Chinese markets. The third point I would like to point out was that a lot of the selling went over to Hong Kong post the Chinese markets getting circuit shut down. And that ended about 3.5% down.
Let's take it across to Jasper then. Jasper, the point that Ajay was making about what's really prompted this sell-off that we saw today in China. What's your own sense? Because with it, it's brought about this massive wave of risk aversion that's sweeping global markets today.
Well, the main trigger really was the weak manufacturing PMI data. Was supposed to see a small increase, actually saw quite a large decrease. And just renewing these same fears that we had in 2015, that China's economy is slowing and that the government have already introduced some stimulus and it doesn't seem to be enough. So calls increasingly for the government to do more, but at the same time, some fear that maybe they don't have the tools in the toolbox, or maybe not the willingness to use the tools in the toolbox to actually counteract this manufacturing weakness.
Paul Schulte and with us as well. And Paul, last time the markets got impacted in 2015 due to the Chinese devaluation. That was the biggest loss for markets at large in India in particular as well. Do you see this current decline lasting for a slightly longer period of time, or do you think this will settle down soon?
My sense is for China, first of all, China, by the way, was one of the best performing equity markets in the world. It outperformed India by 100 miles last year. So, China was up 9, India was down 9 relative to the Shanghai composite. So people are prone to be dismissive towards China, and they forget the resilience of the fixed income market, of the equity market. The difference here is there's going to be, I think, a slight depreciation of the currency going forward, probably on a 4 to 5% basis. But I think a lot of the slowdown has been priced in. And there's going to be a lot of stimulus coming up in China, especially on the tax front and the fiscal front. So I'm not as concerned about China here as many others would think.
Ajay, would you agree with that? Are you as concerned or not? Because, the worry then in the market somewhere, and perhaps this is a bit of a knee-jerk reaction, is that we're somewhere going to go back to those deep dungeons that we saw engulf us last year. There's a lot of talk about, this made in China recession that could be headed our way. So do you believe that, this is just sort of a short-term blips, or is there some sort of storm brewing here?
Well, Tanya, on both sides, there's enough, analysis coming out. One which says that China is cooking the numbers and it's headed for a sustained downturn. The other, which is very interesting, is saying that There's a recalibration of the economy away from the traditional economy. Slowly it's moving towards consumption, and none of those are really captured in the traditional GDP numbers or the PMI numbers. And there's a lot of growth. For example, the service sector growth in China came out very high, but that was totally ignored by the market sell-off today. So I would really rest with the latter. I would say there is a recalibration of China. It's a very activist state. It acts very fast, both tactically in terms of supporting the market, as well as in stimulus terms. They are very nimble-footed. I don't see this lasting too long. I see a stimulus coming by pretty soon, and very active intervention from the Chinese, and which will give some support to the global markets and as well to the Indian markets. Indian markets correction was totally sentiment driven. Nothing wrong in the fundamentals to warrant a 2% cut. With such high volumes, we saw FIs selling, we saw domestics being net sellers today. That was totally unwarranted. It was more sentimental, and I think that will reverse pretty soon.
Yeah, well, I hope it does, because right now the cues are not looking the greatest. The European markets are down, and now DAX is down 4%, and the Dow futures are down about 1.5%, over 1.5%. So it's not looking very great for the markets currently. And Jasper, actually, that would be my question. China was the single biggest factor of the biggest loss for the global markets. How much last year? How much probability would you assign to a made in China recession this year?
Quite likely. I would say that would be probably the number one source of a recession. It was China that pulled us out of the last recession, and it looks like this time around there'll be an inability for them to do that, and maybe even, as you said, cause a recession. So there's one or two risks here, China related, that maybe there's just a natural cyclical downturn. We have had 5+ years, 6+ years since the 2008 crisis. We're sort of due another downturn, but will China be able to save us this time? Probably not. On the other hand, they actually could induce it through just not doing enough economic stimulus to level out growth in some of their traditionally faster growing industries, namely sort of manufacturing and exports. They're trying to reorientate towards the consumer, but that's a sort of longer term process. The consumer numbers, retail spending in China has been looking strong, but that sector of the economy is just not as big as the manufacturing. And so in the meantime, there's that slowdown, there's that balance that has to take place. And there's a risk that China's government just focuses more on the economic reform than they do on the short-term growth stabilization.
Ajay, let's address the question then, where do we go from here? If last year everybody was worried about how FIIs are turning their back on India, at least the one thing that worked out for us was the brisk buying that we saw from domestic institutes. Now, I'm just wondering that if this kind of risk aversion were to stay, do you believe that somewhere we could see even DIIs maybe, tighten their purse strings a little bit?
I think there's a lot of money in the domestic market waiting to get deployed, waiting to enter. If you see, we had 2 IPOs in the pharma sector last year. Both got hugely oversubscribed. Nearly 75,000 crores was the oversubscription. You look at tax-free bonds, a different asset class, but within 1 hour you are getting a subscription for any amount of tax-free bonds. Will probably raise about 40,000 crores of those. So what I am really alluding is there's a lot of money. Second, it's a lot of retail money. 80 lakh SIPs working. That means about 3,500 crores comes into the mutual fund kitty at the beginning of the month after month, with growing SIPs. And SIPs is a good way. People are making money because of the dollar cost averaging. So I would not be very worried on the DIIs front. I think that flow, if anything, will increase as people make more money in the markets. Despite the market underperforming last year, people have made money through the SIP route because of the averaging that has been working out. HNIs have made good money on the small caps and mid caps. So our expectation is DIIs continue to take a lion's share of the market, and probably FIs will follow the global EM aversion that we are seeing, and we could have a soft number for FIs for the year, but DIIs will more than make up for that slack.
I think the other thing is, I don't know if DIs have the option of not invest. I mean, if the SIP money keeps on coming, you will have the DI money coming in. Add to that the fact, Tanya, remember that with all the permissions that are being given to institutions that hitherto haven't invested at all, maybe the DI flow will continue. But the key, of course, I think remains the FIs. And Paul, my question to you is about what will drive market sentiment in large, and where will FIs pump in money? I mean, which country, which data will dominate news?
So I think if we look at a bottom-up picture of the corporate landscape, we are seeing in China, for instance, a souring of most of the entire landscape of metals, copper, coal, oil, gas, and other commodities, for instance. And in other countries where we just don't see a large proportion of commodities and metals in the indices, those markets are in very good shape. Japan is my favorite market in the Far East, for instance, coming up for 2016. I think we just have to really pay attention to the ongoing unwind of the oil and gas sector, because this is an extremely large sector, and there's hundreds of billions of dollars of capex, which I think needs to be canceled. So that has really got to be the focus for investors right now, is to watch how much more damage is going to come to us through the oil and gas sector.
Okay, let's also welcome Arnab Das in on this discussion. Arnab, good evening. What an awful way to start the new year, really. Come back to your trading terminals and you're seeing, red all over your screen. Talk to us about whether you think this scare from Shanghai is a bit of a knee-jerk reaction, and like most other on our panel, do you believe that this too shall pass?
Well, I think we're looking at a phase of adjustment here that is taking place across many markets and many parts of the world economy. Mm-hmm. China is clearly having a bit of a bumpy landing. So I think it's too early to say that it's a hard landing. And even though it may turn out to be a soft landing, it's clearly bumpy in China itself, and is having the effect of a hard landing in many other parts of the world, particularly commodity exporting emerging market countries, several of which are in a recession already. So I think that's the nature of the problem, and it's really a carryover, I think, from 2015. Right? There's no reason why, just because it's the turn of the year, that things should turn around on a dime. I think that this is part and parcel of rebalancing of the Chinese economy from an excessive concentration in net trade and subsequently in investments towards services and on the output side, and towards consumption away from net trade on the demand side of the economy. And that's why we're having all of these various repercussions. Today in particular, of course, is the first real trading day since the tensions in Saudi Arabia, between Saudi Arabia and Iran, escalated over the weekend as well, which is adding a bit of fuel to the fire. But I think the underlying issue is that we have a very uneven, unsynchronized global economy, and that's the problem.
Sure. Arnab, my question though is this. It was not that, one, that the PMI data was horrible. Two, I think the market was working with a slightly weak PMI number from China. That alone couldn't be the reason for a 7% slump, right? I mean, and the reason I'm bringing it up is because all the other markets are, catching that whiff of that cough and crying foul right now.
Yeah, I mean, I think the underlying challenge here is that people are concerned about financial instability in China having a knock-on effect on the Chinese economy and spilling over into the rest of the world. And that's reflected in the behavior of the stock market and in the behavior of the currency and the onshore-offshore spread in response to what's happening in some of the economic data and what that might portend. I think there is this underlying fear that you're going to have this hard landing in China, which is going to spill over even further into the rest of the world than it has. The reason we think that a sort of a bumpy landing is a better way to think about it than a hard landing is that most of the time you don't get a hard landing without a financial crisis. It does happen, but most of the time the financial crisis tends to precede the economic crisis, if there is going to be one. And there are good reasons to think that the Chinese authorities still have the capacity to avoid anything approaching a true financial crisis, and by extension, the likelihood of a very severe hard landing, right? And the reason for that is that the financial system is largely under the control and regulation of the state. Most of the credit is domestically held. And it's really, one pocket lending to another within the Chinese economy. So it's not a traditional cross-border kind of problem. Those are much harder to solve and typically lead to runs, whereas the kind that we're talking about here is easier to manage.
Arnab, hang in there because we've just got enough time actually for closing comments. And Ajay, I'll come to you first. In 2016, what do you suppose, at least in the short term, is going to happen first? Are we going to scale a new high or sink to a new low?
I think we're getting a new high in anticipation of the budget, Tanya.
Super.
Wow. In anticipation of the budget, that's like in about two months' time. Yeah. Ajay, I think we need a good earnings season for that. That isn't happening either.
Well, the entire skepticism, Neeraj, around the street, that's what gives me a lot of belief that markets being front-ending will anticipate a lot of this. We are coming into the season with everybody saying emerging markets will underperform, India will tend to underperform, single-digit earnings, sixth year of earnings derating is what we are looking forward to. Makes for a lot of nice mix overall for the markets. I think markets will surprise.
No, that's the best news we've heard all day. A new high coming as early as the budget. You follow, EMs very closely. Is that something that you see in the offing for Indian markets as well?
Yes, hi. Yeah. I think India is relatively well insulated because it is an importer of commodities. The current account deficit has contracted very sharply, largely because of the collapse in the price of oil, but also partly because of measures that the RBI has taken over the course of the time since the taper tantrum. So I think even if India doesn't make absolute new highs, it will continue to perform relatively well compared to other emerging market countries because it is a closed economy, domestic demand story. Against that, I think that the chances of a big liftoff in the manufacturing sector and the industrial sector more generally seem fairly low because credit is still very heavily constrained. There's more homework to do in the financial sector and, of course, in reform in general, in the case of India, for a significant takeoff to take place. But nevertheless, India is still the world's fastest growing large economy and is, like I say, relatively well insulated fundamentally and economically from all of this turbulence in the Far East and in the Middle East. And if anything, stands to benefit from some of that turbulence. So I think it's the best relative story out there, or among the best anyway.
Okay, and Arnab, I know you don't essentially dwell into market levels or fund flows, so on and so forth, but do you think flows will not be a problem either? I mean, just a broad brush estimate.
Well, I think the flow picture is somewhat mixed. I think the asset class of emerging markets, whether it's equities or debt, continues to suffer some outflows and significant pressures, and that's unlikely to abate in the immediate future. And the other negative in the case of India is, you could say, somewhat quote-unquote technical, in that I think everybody sort of agrees that India is the best relative story and the best turnaround since the taper tantrum, and is so probably therefore heavily positioned that way on average. So I don't think the funds flow picture will be particularly supportive for India, except, again, in a relative sense, because I think people are going to continue to be contending with very weak economic performance in the commodity exporting EMs, whether that's Brazil or Russia or South Africa, and fundamentally worse circumstances in, say, Turkey or in parts of East Asia, as we've been discussing. So I think, there's not going to be a huge amount of support from the flows, but there shouldn't be a huge amount of pressure either.
Gentlemen, I'm afraid we're completely out of time. Lots of unanswered questions, though. But all of you, Arnab, Ajay, Paul, as well as Jasper, thanks so much for joining in on this special edition that we're calling The Big Sell-Off. So, Neeraj, it seems like the verdict at least is that the Shanghai scare is a bit of a short-term blip, but the story is intact.
Hopefully, but I remember flows, very important. Only 3 billion in 2015 versus 20 billion in each of the 3 years. They need to come back for us to do well. So fingers crossed for that.
And that's a discussion for another day then. With that, thanks so much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.